Inflation fears Spurs' new gold rush. Before we get to the news that inflation fears are spurring a new gold rush, let's just cut to a couple of small clips I've put together from some recent interviews where Alasdair Macleod gives some wonderful advice.
So gold is really starting to have a more significant role in the monetary side of things again.
Yeah, I mean, almost by default. I mean, it's there in the background, and the way I would look at it is really, I mean, the way we all look at gold. I mean, we have gold coins. Well, some of us do. Those of us that do aren't about to run out to the shops and spend it. I mean, even though it's legal tender, we're not going to do that, are we? We're going to spend the rubbish first. I mean, this is Gresham's law. We spend the paper stuff first. And we hang on to the gold. And this is actually what Russia, China, and all the other countries around the Eurasian continent will be doing.
You think there's going to be a race for gold with central banks in the West?
Well, I think we've got the makings of an enormous squeeze on the system, which nobody wants to see. I mean, nobody, you and I, if you've got physical gold, would probably say serves them right. But the establishment, if you like, governments and the major banks and all the rest of it, they don't want to see the gold price rising. I mean, they can handle a gentle price rise, but if gold suddenly took off, I mean, this would be, it would just raise so many questions. Not only that, but it would probably break the bullion banks as well, because they're short. I mean, it's as simple as that. And there isn't the liquidity for them to cover. The only cover they get is they go in and say, right, we'll put a backstop on our position, like we will go and we will buy an out of the money option, which we can exercise if, say, the price goes over 2,100. Okay, so, and you will find someone who's prepared to quote an option rate to sell to a bullion bank for a call with a strike of 2,100. I mean, but the whole system depends on the derivative markets not failing. And so that is something which we should also consider, because once gold really gets going, and it's not so much gold rising, it's paper currencies, fiat currencies in the West falling. That's really the key point. Under those circumstances, then there could be a major crisis developing in precious metals markets, because, I mean, China and Russia and all the rest of them more or less corner the physical market. We've just got paper, and that paper is pretty much valueless, really, when things get unstable.
You also mentioned, so we've talked about financial and fiat currency strains and collapses. On the flip side of that are tangibles, real things, commodities, etc., that seem to be burgeoning, with the exception of silver in particular, but also somewhat gold. Eric MC asks a question that many are thinking. There seems to be no catalyst to drive silver and gold. Every headline seems to drive metals lower. Sure seems like manipulation. How can we escape the bank's control over metal pricing?
Patience is the answer. I'm sorry to say this. The reason this comes about, undoubtedly, is the vested interest in the establishment, and by this I mean the bullion banks, is to see lower prices for bullion and silver so they can close their shorts. The short position in the swaps alone on COMEX, I mean, has been in the region of sort of 40 to 45 $billion. I mean, we're talking about huge amounts. I mean, average bank exposure in the swaps is probably in the region of $1.5 to $2 billion. I mean, this is serious stuff. So they don't want to see a rising price for gold. What they want to see is a falling price, and they can then close them off. So, and what we've seen recently is some success for the swaps, because the level of open interest on COMEX has actually declined quite sharply from, off the top of my head, I think we got up close to 600,000 contracts, and now I think we're down to sort of 540, something like that. Maybe more to go from the point of view of the swaps. Now, the other thing I would say is that the investment world, the investment establishment, your favorite investment manager, the guy who runs your pension fund, the guy who's in charge of the insurance company's assets, they're all Keynesian. And so their response is always Keynesian. And what they're seeing now is there is risk, heightened risk in yen, euros, sterling even, whatever else they might have in terms of foreign exposure. So what do? What's the risk-free thing? To a Keynesian, the answer is quite simple, and that's the dollar. So you can see that instead of sensible people, I mean people who really do understand economics, understanding that this is a bigger risk thing which is likely to undermine the dollar as well, and bearing in mind that before this happened, foreigners already owned over 33 trillion. That's nearly 1.5 times America's GDP in dollars, in cash dollars, and also in financial assets. I mean, they're already up to there in dollars, and now they're going up to there in dollars, if you like. This is a very, very difficult situation. But if you're a Keynesian, where else do you go? They don't understand that the true hedge from this situation is actually physical gold itself. I mean, what they do is they say, if you're a Keynesian, you say, well, look, hold on a minute. We're seeing interest rates rising, which basically means that the penalty of holding an asset which produces no income is increasing. And you want me to hold gold? Now this is an argument they would prefer to see because it drives down gold relative to the dollar. And if you're in the banking business, you say, whoopee, this is actually what we want. And so these are the dynamics behind what is actually happening. But the other thing I would say is that the comment that your viewer just made is, I would associate with someone who's looking at gold and silver as an investment. In other words, something that they would hope to sell at a higher price at a later date, rather than true money, which actually should be hoarded. And the reason you hoard money is so that you spend it later because you're worried about everything else. So, if you like, I think that's the psychology behind the question. I don't want to put words in anyone's mouth, but what I would say is that the best way to look at this is you've got to hoard gold and silver, not worry about the day-to-day. If you see the big picture changing in favor of fiat currencies, then maybe you might decide to reduce your exposure to physical gold and silver. But I think that's extremely unlikely. If anything, I think the situation is intensifying. And as we've seen from the drop in currencies this week, I think it's intensifying very rapidly.
So in last week's The Weekend Australian, which is a daily national newspaper in Australia, there was this article, Inflation Fears Spur New Gold Rush. So let's have a look at what they've got to say in this article. So it talks about the state of the economy, and even with this murky outlook, Australians have stepped up their demand for gold in the first months of the year, according to a report from the World Gold Council released this week. Indeed, Australians bought 8.9 tonnes of physical gold in the 3 months to the end of March, a 24% jump in the same period last year. Demand for gold jewellery rose a sharp 40% to 2.7 tonnes over the quarter, while demand for gold bars and coins was up 19% at 6.2 tonnes. Australia has bucked the trend in its rush for gold, says the regional chief executive of the World Gold Council, Andrew Naylor. Local investors, both retail and institutional, are also pumping money into the yellow metal through ASX-listed exchange-traded funds such as ETF Securities Physical Gold ETF, ASX ticker code GOLD, which has seen net inflows of close to 150 million in the year to date, including 40 million in March, 40 million in April. Gold ETFs offer low-cost access to physical bullion via the stock exchange without the need for investors to actually store their own bars. ETF securities offering provides a return equivalent to the movement in the Australian dollar price of gold, less a daily management fee, and is backed by gold bullion, powered by who other than JP Morgan Chase. And this is a big problem, in my opinion, with a lot of investors, is they're pouring their capital into what some could say synthetic products, whether it's unallocated or ETFs. I've mentioned on this channel multiple times, the only ETF that I have any sort of trust in is the Sprott ETFs. But what this does show is that a lot of retail investors and institutional investors, now I know a lot of institutional investors do buy these type of ETFs. And I've spoken with an institutional investor who actually has shed some light on the whole, is the precious metals market manipulated and whatnot. And this person put it to me that yes, it is, but these institutional investors, when they buy through the bullion banks, their clients like the JP Morgan Chases, JP Morgan Chase do want these big institutional investors to profit. And so when the big institutional money does flow in, then the bullion banks cease manipulating and allow the price to move. And that's when we get these big price moves. So this institutional investor put it to me that you'll see the big moves in precious metals when the institutional investors pour funds into it. When it's the retail investors, JP Morgan Chase and all that couldn't give a stuff. In fact, they just couldn't give a stuff. So whether that's true or not, that's up to you to decide. ETF Securities Head of Distribution Kanish Chu says professional investors are starting to increase their allocations to gold amid the uncertain outlook. We've got a number of investors at the institutional, private wealth, investment professional level who have strategic model allocations to gold, and they're adding to that allocation because of the geopolitical environment and the inflation. That's very key. And I know everyone's frustrated with gold and silver, in particular silver at the moment. But what we're seeing in geopolitics, with the conflicts around the world, this split between the East and the West, the East accumulating real assets, real commodities, real gold, while the West continue down this paper fiat model, which, as you all know, is a Ponzi scheme ultimately, because it needs to continue to be built upon itself just to sustain itself. And when it doesn't, that then comes collapsing down. And I think Alasdair gave some good advice what investors should do, and that's buy the physical metal and hoard it. Keep it. It's real money. I've shared that, yes, I do trade, as in I use wealth cycles to accumulate wealth, and, between gold, silver, other assets. So I do measure my gold and silver versus other assets. But I also hold, I've actually never sold my gold. I've sold silver. I've never sold my gold. And that's because I want it there as insurance. Hopefully I never have to use it. Hopefully, I can hand it down to my kids and my grandkids and hopefully great-grandkids. But I think, if you missed Alasdair's advice at the start of the video, rewatch this video and listen carefully to his advice, especially in this particular climate as the world is going through big changes, and we're only starting those changes. There's a lot of vested interests, elites on all different sides that have got vested interests that want to change the world, change our economic, political, and social structure. And so there is going to I believe, come a time very shortly where people from retail to institutional, private wealth, you name it, even sovereigns, and we've already seen that, flowing into gold in particular. But, you know, when that becomes too pricey, everyone will go for its little brother, silver, just for safe havens, out of fear of inflation, fear of currency devaluation. That's picking up. The retail, the mums and dads, the fact that this article is being written in a mainstream newspaper in Australia shows that people are waking up. More and more people are being educated. More and more people. But what we need as a community of sound money advocates, for all of you listening to this video, watching this video right now, is you need to share this video. You need to share all of those experts out there on sound money and Austrian economics, and share it with your friends and family. Help them, educate them before all of this stuff plays out, and then gold becomes and silver becomes unattainable, or at least unattainable at a decent price. And teach them the difference between physical and this synthetic stuff. Some significant private wealth clients were sitting with a 2 to 5% allocation of gold in their portfolio. They're now increasing that. They're applying a tactical overweight at the moment to their strategic allocation. Some clients, the allocation to gold is pushing up to 10% of portfolios, he adds. One client has got upwards of 15% allocated to gold. That's obviously very bullish. Beta Shares Gold Bullion ETF, ticker code QAU, saw a spike in inflows this week following a shock 5.1% inflation print, CPI. While the fund recorded just under $2 million in net inflows for the month to April 27, further $8 million flooded in following the CPI data release on Wednesday, showing some investors are worried the Reserve Bank will not be able to get inflation under control. So that is quite a large inflow into this ETF. Once again, it's an ETF, folks. Look, it's great that people are learning and wanting to jump into gold. They just need to understand the difference between ETF and actually holding the physical. As they say, if you don't own it, you don't own it. If you don't hold it, you don't own it, right? But I see a time coming very soon where Doug Casey's going to be proven right. He talks about, gold and silver will be like siphoning Hoover Dam through a garden hose. And I don't think we're too far off that. And I know a lot of precious metals investors, especially those that bought in the last 12 months, have been quite frustrated. For those of us who have been buying in recent years, we've seen good gains from when we first started buying. But we also know that it's not the end, and things are changing in a big way. So anyway, I thought this article was quite interesting. The fact that it was reported in a mainstream newspaper, a national newspaper, and that both retail investors, institutional investors, and private wealth funds are now pouring into the metal. So we're seeing inflows into the metal, into the ETF though, and that's the difference between the East and the West. We just have all these derivatives and paper assets, where the East, they buy the real hard physical stuff. They store it. So anyway, guys, what do you guys think? Love to see your thoughts and opinions in the comments below. Do you see a gold rush coming? Do you see Doug Casey being proven right? Please leave your comments below. Once again, if you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.